The turtle channel trading strategy. The best scalping and swing trading strategy for beginners that no one ever told you. This video provides a clear, winning, step-by-step guide to how to successfully trade in the forex, stocks, or any financial markets and generate consistent profits. So, by the time you finish this video, you'll know exactly when to enter high probability trade using the turtle channel trading indicators. As usual, we'll have plenty of practical examples. The idea is to fully understand this wonderful trading strategy and to make the most out of it. If you want more videos more often, please smash the like button, subscribe, and turn on the notifications bell so that you know exactly when new content is released. A very important point before we start. Everything we discuss in this video can be used for currency trading, stock trading, and crypto because price action stays relatively consistent across different assets, so we're going to go very in-depth in this video. One of our favorite strategies is the reversal scalping and swing trading strategy. Trend reversal strategies are often very difficult to implement. Traders who trade on trend reversals are often trading against the flow of the current market trend. For this reason, the trade setups taken by most traders do not gain traction right away. Traders who are not used to trading trend reversals end up exiting the trade prematurely. However, with a system in place and with the right mindset, trend reversal strategies could become easier. One of the simplest ways to trade trend reversals is through oversold overbought strategies. It is simple to understand and easy to implement. Traders could enter and exit trades based on rules rather than on gut feel, making it a lot easier for new traders. The Turtle Channel Trading Indicator. The Turtle Channel Indicator is a very simple indicator that allows the traders to trade based on 10 and 20 days moving average breakout. To set the stop loss and take profit while using the 10 days breakout method, use the 5 days low or high. For the 20 days breakout, you need to use the 10 days low and high. For the 40 days breakout, you need to use the 10 days low and high. The Turtle Channel Indicator is a powerful trend determiner. It was developed by Bill Eckhart and Dennis Gartman. They devised the core algorithm based on the N days breakout formula. The indicator uses the highs and lows of the market and finds out the potential breakout zone in the chart. Price action traders identify trending markets based on swing highs and swing lows, consistently forming either higher highs or lower lows. Price action and market flow traders also identify the swing highs and swing lows as support and resistance levels. The Turtle Channel Indicator is a trading tool which can be used for the same trading concept, identifying reversals based on the breaks of the support or resistance levels. Trend Following Indicator. The Turtle Channel Indicator is a trend-following technical indicator which is based on price action, particularly the swing highs and swing lows of price. This indicator plots two types of lines. The first line is a dotted line, which represents the short-term trend. The second line is a solid line, which represents the long-term trend. The lines shift around price action to indicate the direction of the trend. The lines are below price action whenever the trend is bullish and above price action whenever the trend is bearish. The solid line also changes color to indicate trend direction. It plots a blue line to indicate a bullish trend and a red line to indicate a bearish trend. How the Turtle Trading Channel Indicator works. The Turtle Channel Indicator uses an algorithm which detects the highs and lows over an N period of time. The dotted line has a lower N period as a preset, while the solid line has a higher N period. The indicator then plots its lines based on the highest high or lowest low of price action, moving against the direction of the identified trend. The rationale is that these levels are considered as the support or resistance levels of price action. The indicator shifts and reverses whenever price action moves against a trend crossing over and closing on the opposite side of the lines. This can then be interpreted as a trend reversal. How to use the Turtle Trading Channel Indicator. The Turtle Channel Indicator has a few options within its indicator settings. Trade period refers to the N period used for the solid line, while stop period refers to the N period used for the dotted line. Strict toggles the indicator to detect trend reversals on the highs and lows of a candle, breaching the lines instead of the close of the candle. Display alerts toggles the trade signal alerts on or off. Buy trade setup. When to enter. Open a buy order as soon as the lines shift below price action and the solid line changes to blue. When to exit. Trail the stop loss below the lines until stopped out in profit. Sell trade setup. When to enter. Open a sell order as soon as the lines shift above price action and the solid line changes to red. When to exit. Trail the stop loss above the lines until stopped out in profit. One of our favorite strategies is the turtle channel trend reversal trading strategy. The primary reason I like our reversal trading strategy is because it gives us the opportunity to enter the market very close to support or resistance areas. One of the simplest way to trade the turtle channel trend reversal is through stochastic oscillator oversold and overbought strategy. It is simple to understand and easy to implement. Traders could enter and exit trades based on rules rather than on gut feel, making it a lot easier for new traders. And now, what is a stochastic oscillator? A stochastic oscillator is a momentum indicator comparing a particular closing price of a security to a range of its prices over a certain period of time. The sensitivity of the oscillator to market movements is reducible by adjusting that time period or by taking a moving average of the result. It is used to generate overbought and oversold trading signals, utilizing a 0 to 100 bounded range of values. How do you read the stochastic oscillator? The stochastic oscillator represents recent prices on a scale of 0 to 100, with 0 representing the lower limits of the recent time period and 100 representing the upper limit. A stochastic indicator reading above 80 indicates that the asset is trading near the top of its range, and a reading below 20 shows that it is near the bottom of its range. What does %K represent on the stochastic oscillator? On a stochastic oscillator chart, %K represents the current price of the security, represented as a percentage of the difference between its highest and lowest values over a certain time period. In other words, K represents the current price in relation to the asset's recent price range. What does %D represent on the stochastic oscillator? On a stochastic oscillator chart, %D represents the 3-period average of %K. This line is used to show the longer-term trend for current prices and is used to show the current price trend is continuing for a sustained period of time. Stochastic oscillator to identify overbought and oversold levels. Just like MACD, stochastic also has a faster moving metric and a slower moving metric. The general theory serving as the foundation for this indicator is that in a market trending upward, prices will close near the high, and in a market trending downward, prices close near the low. And hence in a range of 0 to 100, 80 or higher is considered as overbought, indicating an upcoming downtrend. While 20 or lower is considered to be oversold, indicating an upcoming uptrend. Stochastic oscillator divergence. Now that the stochastic is set up, you can start to look for divergence. A divergence occurs when the indicator doesn't move in line with price. For example, the price makes a new high, but the stochastic fails to reach a new high. Or, price makes a new low, but the stochastic fails to make a new low. The former is a case of bearish divergence because it signals potential weakness, and the latter is a case of a bullish divergence because it indicates potential strength. When a divergence occurs, it should put you on guard for a potential change in price direction. Although, divergence is not a timing indicator, it may take some time for a reversal to occur following a divergence. Therefore, don't trade just on divergence. When you have a bearish divergence, wait for the price to break lower before going short. When you have a bullish divergence, wait for the price to break higher before going long. The Turtle Channel Trend Reversal Trading Strategy. This trading strategy produces trade signals based on the turtle channel trend and stochastic oscillator overbought oversold signals. In this configuration, the turtle channel is a long-term indicator, which means it will help you identify and trade with the long-term trend. The basic trend principle to remember is to buy low and sell high. Also, if you are able to spot major market movements, the turtle channel will help you execute positions based on large swings. Buy trade setup. Step 1. The turtle channel lines are below price action, or the trend is bullish. Step 2. You look at the stochastic oscillator, then make sure both %K and %D lines are in oversold regions or bullish divergence. Step 3. Take a buy or long position when the stochastic lines cross above the oversold regions. Step 4. Ensure that both of the stochastic lines has not hit overbought levels yet. Stop loss. Set the stop loss below the nearest swing low. Profit target. Trail the stop loss below the dotted lines until stopped out in profit, or use 1 to 3 risk-reward ratio. Sell trade setup. Step 1. The turtle channel lines are above price action, or the trend is bearish. Step 2. You look at the stochastic oscillator, then make sure both %K and %D lines are in overbought regions, or bearish divergence. Step 3. Take a sell or short position when the stochastic lines cross below the overbought regions. Step 4. Ensure that both of the stochastic lines has not hit oversold levels yet. Stop loss. Set the stop loss above the nearest swing high. Profit target. Trail the stop loss above the dotted lines until stopped out in profit, or use 1 to 3 risk-reward ratio. This should be simple enough. Or, in this video, I've included a template with the system that you can simply upload to your chart, and it will automatically plot all these indicators perfectly on your charts, so there's nothing for you to worry about. Get the download link on the description. Here are other examples of the turtle channel trend reversal trading, to fully understand this wonderful strategy, and to make the most out of it. The primary reason I like the turtle channel trend reversal trading strategy is because it gives us the opportunity to enter the market very close to support or resistance zones. As always, if you learned something new, or if you want more videos more often, make sure you subscribe, click the notification bell and leave us a like to show your support. See you next time.